The truth is, most investors still don't understand what they're holding. In 2025, the world of crypto investing is no longer the wild frontier it once was. It's evolved, matured, and in many ways become something entirely different. But with that evolution comes a new kind of risk, one that most people ignore until it's too late. So today we're asking the only question that truly matters. Is crypto investing still worth it in 2025? Or have we crossed the point where the opportunity has turned into danger? Welcome to the Wealth Blueprint, where financial freedom is built not on hype, but on strategy. Let's begin with the reality of where we stand. In late 2025, the cryptocurrency market is once again at a crossroads. Bitcoin has stabilized above $70,000, Ethereum hovers around $3,800, and global crypto adoption continues to rise. On paper, it sounds like progress, but the truth is, the market underneath has changed dramatically. Institutional control, not retail speculation, now drives most of the price action. The days when retail traders could buy the dip and 10 times their portfolio are mostly gone. Today, major hedge funds, sovereign wealth funds, and asset managers hold a combined 65% of Bitcoin's circulating supply. The retail investor, less than 10%. This is not the same crypto market that rewarded early adopters. It's a structured, algorithm-driven ecosystem controlled by entities with billions of dollars at stake. But that doesn't mean opportunity is dead. Far from it. What it means is that the playing field has changed. And if you're still using 2021 strategy in 2025, you're already losing. Let's break it down even further. The crypto market in 2025 is shaped by three key forces: institutional integration, major financial platforms now offer tokenized assets, regulated Bitcoin ETFs, and blockchain-based settlements. Government oversight. Over 70 countries now classify crypto as a taxable, reportable asset. Privacy coins? Nearly extinct. AI-powered market dynamics. Trading bots and algorithmic systems dominate short-term volatility, making manual day trading nearly obsolete. In other words, if you're trying to beat Wall Street's bots, you're playing a losing game. But if you understand long-term value, risk-adjusted returns, and capital preservation, crypto can still serve as a powerful hedge and wealth accelerator. Because even with all the regulation and centralization, one truth remains. Bitcoin is still the only asset class outside traditional monetary control. And that single fact is the foundation of its continued relevance. Everyone talks about volatility, market crashes, and scams. But those are surface-level risks. There are two deeper threats that most investors fail to recognize. And they are the ones most likely to destroy portfolios quietly, without warning. Risk number one: liquidity fragility. The illusion of stability in the crypto market is exactly that, an illusion. While prices may appear stable, the underlying liquidity that supports these assets is dangerously fragile. Why? Because liquidity today is institutionally controlled. When big players withdraw capital, often instantly and without notice, the price structure collapses faster than retail can react. Think of it like this. You're standing in a massive skyscraper made of glass. It looks strong until the foundations beneath you start to crack. The market's liquidity base, the real buying power, is what gives it life. When that dries up, panic begins. We saw this in 2022 with FTX. We saw it again in 2024 when smaller exchanges began delisting tokens en masse under new regulatory pressure. And now, in 2025, we're seeing it again with the fragmentation of cross-border liquidity pools due to increased oversight. That's why risk management is everything. It's not about timing tops or bottoms. It's about understanding that liquidity is the invisible hand that decides who wins and who loses. Risk number 2, psychological fragmentation. The second, and arguably more dangerous, risk is not external, but internal. It's the investor's own psychology. The average retail investor today is overwhelmed by conflicting narratives. Bitcoin to $250,000. One day, crypto is dead. The next. The constant noise creates fatigue, doubt, and impulsive decision-making. Investors buy at the top, panic sell at the bottom, and repeat the cycle endlessly. This isn't just bad behavior. It's financial self-sabotage. The greatest enemy in crypto isn't volatility. It's emotion. To survive and thrive in the modern crypto environment, you must become data-driven, disciplined, and detached. If you let fear or greed dictate your strategy, you're not investing, you're gambling. And gambling is how you lose your blueprint for wealth. Let's cut through the noise. In 2025, there are thousands of so-called crypto experts promoting quick wins, short-term trading bots, and hidden gems. 99% of it is nonsense. The only strategy that still works, the one used by the most successful investors in the world, is DCA and HODL. DCA, DOLLARCOSTAVERAGING. It's simple, powerful, and timeless. Instead of trying to time the market, you invest a fixed amount regularly, regardless of price. Over time, this averages out volatility and smooths your entry points. This isn't about chasing 1,000% returns. It's about consistent wealth compounding and reducing emotional stress. Think of it like training your financial discipline muscle. Every consistent deposit is a rep toward financial freedom. If you had started dollar-cost averaging into Bitcoin after the 2022 crash, you'd be up over 300% today. Not because you predicted the bottom, but because you stayed consistent. That's the difference between traders and investors. Traders chase emotion. Investors follow systems. And in 2025, systems win. HODL. Hold on for dear life. HODLing is not about blind faith. It's about strategic patience. You hold because you understand value. You hold because you've done your research. You hold because you know the historical cycles of Bitcoin, the halvings, the retracements, the recoveries. And you trust the mathematics, not the noise. When you combine DCA and HODL, you create the most effective risk-adjusted strategy in modern crypto history. It's boring, it's slow, but it works, and it keeps working. Because wealth isn't built by reacting to headlines. It's built by repetition, discipline, and control. And remember this, your job is not to beat the market, it's to survive it long enough to win. Now that we've covered the strategy, let's talk about what to avoid. Altcoins, or alternative cryptocurrencies, can offer potential upside, but they're also the single greatest source of capital destruction in this space. So here are the 5 red flags that should make you run, not walk, from a project. Red flag number 1, no clear use case. If a coin doesn't solve a real-world problem or provide a measurable improvement over existing systems, it's worthless. Period. Fancy websites and futuristic white papers mean nothing if there's no actual demand. Ask one question: what real-world problem does this solve and who's paying for it? If the answer is unclear, stay away. Red flag number 2, tokenomic inflation. Most investors never read tokenomics, and that's where they lose everything. If a project continuously mints new tokens or unlocks large developer allocations, dilution is guaranteed. Your share of the pie shrinks while insiders profit. In 2025, with staking and liquidity farming platforms everywhere, this risk is more hidden than ever. Always check emission schedules, lockup periods, and vesting terms. If insiders control over 40% of the supply, run. Red flag number 3, unverified team or anonymous founders. If you can't find transparent information on the founding team, their past projects, credentials, or verifiable profiles, it's not a risk worth taking. Anonymity in crypto is no longer a symbol of decentralization. It's a warning sign. Scammers hide behind anonymity. Builders stand behind their work. Red flag number 4, artificial hype cycles. In 2025, crypto marketing has become an art of manipulation. Beware of coins that explode overnight due to influencer campaigns or AI-generated engagement. When you see trending hashtags, guaranteed pumps, or suspiciously synchronized hype, you're likely witnessing a liquidity trap. And by the time you buy in, insiders are already selling out. Remember, when it's everywhere, you're already too late. Red flag number 5, lack of regulatory clarity. This one is subtle but deadly. If a project is operating in gray zones, avoiding audits, or using non-compliant exchanges, regulatory crackdowns can erase it overnight. In 2023, we saw the US SEC target tokens like XRP and BNB. In 2025, the list is growing, faster than most expect. Before investing in any coin, ask, can this survive regulatory scrutiny? If the answer is uncertain, protect your capital and stay out. Let's talk about what truly defines the market in 2025. Regulation. The crypto market is no longer a digital Wild West. It's becoming a regulated asset class, similar to commodities or securities. And while that may sound restrictive, it's actually the best thing that's ever happened to long-term investors. Here's why. For the first time in history, crypto assets are now recognized under global financial frameworks. That means better protection, transparency, and legitimacy. But it also means more oversight. In the US, the Digital Asset Stability Act now requires all major exchanges to disclose their reserves and undergo quarterly audits. This has already removed over 200 shady exchanges from the ecosystem. In the EU, MiCA regulations enforce strict compliance for stablecoins and custodians, protecting investors from another Terra Luna-style collapse. And in Asia, particularly Japan and South Korea, crypto banking integration has become seamless, allowing users to transfer, lend, and invest within regulated financial apps. In short, the era of regulatory darkness is over. But with that comes responsibility. Every investor must now treat crypto as a legitimate, reportable investment, not an offshore secret. And this is where most people fail. They refuse to adapt. They cling to the old days of unregulated trading, privacy wallets, and tax evasion. That's a critical mistake, because in this new era, compliance isn't optional. It's the price of participation. The investors who thrive in this environment will be the ones who embrace transparency, understand regulation, and play long-term. And that brings us to the final section, the ultimate warning for 2025. Let's be clear about one thing. Crypto investing in 2025 is not dead, but the easy money era is. The next decade of crypto wealth will not belong to gamblers or influencers. It will belong to strategic investors, those who understand both risk and resilience. So before you invest another dollar, ask yourself 3 questions. Do I have a defined exit strategy? Do I understand my risk tolerance? Am I investing based on data or emotion? Because every financial disaster in crypto history began with emotional decision-making. In 2025, survival is success. The investor who avoids mistakes wins. That's why your blueprint must focus on 3 pillars. Capital preservation, never risk more than you can lose. Disciplined strategy. Automate your DCA, review quarterly, ignore daily noise. Long-term vision. Hold assets with proven fundamentals. Bitcoin, Ethereum, and regulated blockchain infrastructure plays. Everything else? Noise. Distraction. Hype. And here's the final truth. Crypto investing is no longer about getting rich. It's about staying smart. The ones who treat it like a get-rich-quick scheme will lose everything. The ones who treat it like a 10-year strategy will quietly build generational wealth. That's the difference between chasing the storm and owning the lightning. So as you move forward, remember this: your wealth blueprint is built on clarity, not chaos. Your strength is in patience, not speed. And your future belongs to the strategic, not the impulsive. Thank you for watching The Wealth Blueprint. Stay disciplined, stay informed, and remember, in the world of crypto, the real opportunity lies in surviving the risk.